think we should expect a pause. That would make sense. Of course, gold's benefiting as well from this downdraft in the US dollar, but be that as it may, the work that we've done, and we published it, and this is probably within the next 5 years, we believe, because gold is following its historical pattern in a bull market, which means what? It means in this bull market, the peak will be somewhere close to $6,000 an ounce. So I am not trading around it. I am buy and hold. And if there's dips, I call my dealer and I buy more gold bullion, or actually what I prefer now are gold coins.
Gold prices held onto modest gains on Tuesday after rebounding from an intraday low near the $3,300 mark, as optimism around U.S.-China talks lifted overall risk sentiment and drove U.S. equities higher. The yellow metal was last seen trading around $3,328, up 0.10% on the day. Despite the initial drop early in the session, gold managed to find strong buying interest, highlighting the continued bullish sentiment in the market. The broader outlook remains favorable, with dips being viewed as buying opportunities. The presence of central banks as consistent gold buyers reinforces this outlook, particularly in an environment marked by macroeconomic uncertainty and geopolitical risks. DavidRosenberg, a senior financial analyst, notes that while short-term pauses in gold's rally are to be expected, the longer-term outlook is significantly more bullish. Drawing on historical trends and monetary cycles, Rosenberg believes gold could climb as high as $6,000 per ounce within the next 5 years. His view is underpinned by the steady shift in central bank behavior, especially since 1999, when European central banks began halting gold sales. Since then, many central banks, particularly those outside the BRICS bloc, have become net buyers, gradually shifting their reliance away from the US dollar. He cautions that betting against central bank activity in gold is a risky strategy. Ongoing geopolitical tensions continue to support the case for gold as a haven. Remarks from former U.S. President Trump about Iran's increasing aggression in nuclear negotiations, along with Russia's assertive stance in Ukraine's eastern region, are adding to the risk premium. These developments may pave the way for gold to test the $3,350 level in the near term. Adding further support to the bullish case, China's central bank confirmed on Saturday that it had increased its gold reserves for the 7th consecutive month in May. This consistent accumulation highlights the strategic importance of gold in global reserve portfolios and signals continued demand from one of the world's largest economies. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop.
Liberation Day was a big day for me. I think Liberation Day liberated us from our sanity. When Donald Trump went in front of the cameras with all these reciprocal tariffs, and every country had a different number. It was like a bingo game. But there was a method to that madness, because those levies reflected two numbers. And that's why each country had a different number, because it reflected the ratio of the bilateral trade surplus that country X ran against the United States. That trade surplus divided by its exports, expressed as a percent, and then added on to the 10% baseline tariff. And so what was the message that the president was sending? Was that he wants the bilateral trade surpluses that countries have with the United States to vanish completely. Even though it's completely appropriate and normal, and I would say desirable for the world's reserve currency to be the country that runs trade deficits with the rest of the world. Because being the world's reserve currency means that you attract all this capital inflow. That capital inflow generates wealth, generates spending that gets spent in imports. No other country in the world has such a low savings rate as the United States. No country in the world has a consumption to GDP ratio of almost 70%. And so what happens is that the capital account and the current account have to balance. It's called the balance of payments. So if Donald Trump wants to shrink the trade surplus, trade deficit that the U.S. has and get it to zero, what happens to the capital account? And what is the message on Liberation Day? The message beneath the message, and I wrote about this, is that what is he signaling? You got to think that this is somebody who's been talking about unfair trade and tariffs since 1987. And now he can do something about it. I think the message was that the burden on the middle class and middle America of being the world's reserve currency is just too much. Mm-hmm. That's the first time that I wrote a report saying that for the first time I'm writing this, that perhaps in my life we will see the end of the US dollar being the reserve currency. We just don't know what's going to pick it up. Mm-hmm. But remember, it could well end up being the euro. Mm-hmm. It could end up being the euro. The euro was supposed to be the challenger in 1999, if you remember, on its introduction. But it's hard to make book right now. But I would say that, when you're taking a look at things like CDS spreads, and you're taking a look at, what that hidden message was. That hidden message was that we don't want to run trade deficits anymore. Even though it's completely normal for the United States to be running trade deficits, there's nothing wrong with it. It's actually the role of the reserve currency. Mm-hmm. Understanding that the balance of payments have to balance. And the message, like I said, is that maybe the world's reserve currency is just too much to bear. And look, this is, I think that Donald Trump will continue to push the envelope. You're asking me, is he moving to reset and reshape balance of trade? 100%. And the last president to have done it on this scale was Richard Nixon. Mm-hmm. Correct? Richard Nixon. Mm-hmm. And so going off the gold standard. So this is going to be, so I think that we are in the early stages of heightened state of uncertainty, confusion, and chaos. It's not going to go away anytime soon. As far as Donald Trump's concerned, this is all going to be for the greater good. As far as gold is concerned, look, gold, how do you value gold?
That was going to be another.
The crypto people value Bitcoin on the relative value trade on gold. Mm-hmm. They call it digital gold. I say, okay, well, I'll just buy the real thing because the beauty about gold is that it doesn't have correlations with so many other things. It's such a great non-correlated asset to have in your portfolio. Bitcoin is most correlated with the NASDAQ 100. I don't want to buy gold if it's correlated with the NASDAQ 100. In fact, it's inversely correlated with the risk on trade. That's why you want it in there. It's a ballast in the portfolio. But how do you value gold? How do you do it? You can't do a dividend discount model on it. You can't do, real interest rates, inflation expectations, default risk, recovery rates, term premium. How do you value gold? Gold is basically 1 divided by U, where U is uncertainty. And on top of that, I started turning bullish on gold back in 1999 when I was just making that transition from the Bank of Montreal to Merrill, when the central banks starting in Europe announced that moratorium on their gold sale program that had undermined gold for so many years. So let's not forget, especially those people that watch QE, let's not forget the power of the central banks. And we're talking about all of the central banks globally, not just the BRICS, not just China. There are no central banks globally selling gold. 3/4 of them are buying gold every single month. Mm-hmm. They are diversifying. That might help explain the downdraft in the US dollar. Mm-hmm. And the strength in gold. And you don't want to bet against central banks. They have deep pockets, but there definitely is a reallocation and a diversification among central banks back into gold. And I imagine that the day that I hear an end to that program, I'll reconsider the gold. We did all sorts of work on this, all sorts of work on gold. And I would tend to agree with you, up almost 30% 2 years in a row. I think we should expect a pause. That would make sense. Of course, gold's benefiting as well from this downdraft in the US dollar, but be that as it may, the work that we've done, and we published it, and this is probably within the next 5 years, we believe, because gold is following its historical pattern in a bull market, which means what? It means in this bull market, the peak will be somewhere close to $6,000 an ounce. So I am not trading around it. I am buy and hold. And if there's dips, I call my dealer and I buy more gold bullion, or actually what I prefer now are gold coins because they're prettier. But that is actually gold remains probably.
While economists expect only modest gains in upcoming data, any upside surprises could unsettle markets already sensitive to inflationary pressures, primarily driven by the impact of tariffs imposed during President Donald Trump's administration. These inflation concerns continue to weigh on investor sentiment, as persistent price pressures could pose risks to the labor market and broader economic growth. Simultaneously, the upcoming government debt auctions will serve as a key test of market appetite for long-duration U.S. Treasuries. With federal deficits and overall debt levels drawing heightened scrutiny from both economists and financial market participants, this week's auctions are expected to offer crucial insight. The Treasury Department is set to issue $39 billion in 10-year notes on Wednesday, followed by $22 billion in 30-year bonds on Thursday. DavidRosenberg notes that bonds appear increasingly attractive in the current environment. However, he acknowledges the legitimate challenges facing fixed-income markets. Chief among them, the need for the U.S. to refinance approximately $9 trillion in Treasury debt, alongside uncertainty around inflation, much of it tied to protectionist policies and supply chain disruptions. These concerns are causing hesitation among investors, particularly when short-term cash instruments are yielding over 4% with virtually no risk. In such an environment, committing to longer-duration debt becomes less appealing, especially when inflation and fiscal sustainability remain unresolved questions. Let's get back to the interview.
You could look at the equity risk premium any number of ways. One of the ways you might want to look at it is the cyclically adjusted PE ratio, the inverse of that, which is the earnings yield, compared to the real, say, 10-year yield or the real long bond yield out of the TIPS market. And the relative valuations, stocks against bonds, is the most extreme it's been. It's at pretty well at the same level it was in the summer of 2007. And that was around the same time, if you remember, that Chuck Prince at Citi was telling everybody you got to keep dancing until the music stops. Well, the music always stops. And then the music always, comes back on the sound system. That's just the cycle of play. I like how bonds are priced right now. I think that it's just a waiting game. We've got obvious concerns over $9 trillion of Treasury refinancing. That is in the market. Everybody knows that number. But that's been a source of frustration. You've got the concerns over how much inflation is going to go up and for how long from the tariffs. And of course, all this plays into, the fact that, how much duration do you want to add when, cash is paying you well over 4% with no duration risk, no capital risk. So that's the one thing to keep in the back of your mind is that, and this is more for the stock market crowd, is that the one thing we can say with certainty is that Tina is no longer around, right? There are alternatives. So alternatives, Ginnie Mae coupons, triple B corporates, or treasuries, or treasury bills. Like basically, when you go back to the last time the multiple was where it is today, the forward multiple now in the S&P 500 is 21. And that's where we were, for example, back in good part of 2020, 2021, we were at these multiple levels. But you see, back then, the risk-free rate was 1%. Today, it's closer to 4.5%. So that's very interesting that the stock market's telling you that it's going to price itself as though the risk-free rate is back near the floor. That's where the math just doesn't add up for me. So in terms of how I see the situation and understanding all the impediments, that are plaguing the bond market over the course of the past few months, when we were at the lows in the 10-year Treasury note yield back at the peak of the COVID recession, it only took a 6 to 7 basis point increase in the yield to generate a negative return in your 10-year Treasury portfolio. You had no coupon protection, almost zero. Today, we have, call it roughly 4.5% 10-year note. What would it take for you to lose money in the bond market? The yield would have to go up 70 basis points, not 6 or 7, 70. Ergo, we would have to go back to the highs, not just to the highs. We'd have to go above the 5% cycle peak back in October 2023, when the Fed was still in its tightening cycle, and we had a completely different economy on our hands. Underlying inflation is lower today than it was then, and the unemployment rate is higher than it was then. So I like that math, that you have to go up 70 basis points to generate no return in your bond portfolio, because I really don't believe it would have to be one hell of a shock for yields to actually break above where they were in October 2023, when there was a ton of bad news being priced in to the Treasury market. Well, what if we look at the alternative? What if the 10-year note yield goes down 70 basis points? Is that outlandish? It takes us back to where we were last September. It doesn't take us back to where we were 5 or 10 years ago. It wasn't that long ago. Well, that would generate a total return of plus 10%. So up 70 beeps, 0, down 70 beeps, plus 10%. And so I like that range.
As gold holds firm amid geopolitical rumblings and fiscal strain, it continues to prove its role as a dependable hedge in times of global instability. Even as risk assets regain some footing, persistent central bank purchases and a cautious investor stance underscore the more profound unease surrounding inflation, currency stability, and sovereign debt management. With shifting reserve strategies and a wary eye on long-term bond markets, gold's upward path appears resilient, fueled by both structural realignment and strategic foresight. The current environment suggests we may be witnessing not just a temporary rally, but a broader revaluation of safe haven assets. Is the global financial landscape entering a new era where gold regains its status as a primary store of value, given the mounting macroeconomic fragilities? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.